Hey folks, David Frost, my strategic forecaster, here for another episode of Common Sense Market Analysis. Today is Thursday, February 2, 2017. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. First, I'll offer my apologies for the technical glitch last night. Not sure exactly what happened, but it apparently is worked out. So let's go forward. So what we're looking at is on the daily chart, we're looking at another day where we hung around the 227.50, had a relatively narrow ranging day. So from low to high, wasn't that large of a range day, very light volume, pierced through the 20 period moving average, bounced back up to close above the 227.50 area. And just on a daily chart, the 10-minute chart, you can see in the last portion of the day, the last hour or so of the day, the market staged a bit of a rally off of a retest of the low from earlier and powered through to close above the 227.50. So day in, day out, we continue to close above the 227.50. However, let's review a couple of things that are pertinent and I think helps give us the roadmap going forward on what to expect based on what happens in the market. And tomorrow, we'll note that we have the non-farms payroll report at 8:30 a.m. Eastern Time, which is a phony jobs number. So you can expect the market to take a cue, at least early on, from whatever news that is. The market will generally pick a direction, up or down or both, and get a little bit of whippy, as will the bond market, gold, the dollar, oil. All the markets kind of tend to jockey for position in front of and then tend to get whipped around like an EKG around those announcements. So we certainly could see a dip or we certainly could see a rally. And generally speaking, and I'm going to show you a couple of anomalies that were prevalent in today's market, which leads me to believe that there's some unusual activity going on. So we really should be in the midst of a larger move in the making. But if you recall, go back to last Friday. I made that prediction and I said that we should trade down into Tuesday and then stage a rally, potentially a quick one up to new highs. Well, the second part of that didn't happen. The first part did. Then we retested the low on Wednesday and we started up and then we failed again. So remember, if you even go back farther, I said that the end of this week or around this weekend was a culmination of an important cycle. So I'm looking for a turn to occur in and around this period of time. So I thought it would be at a high and then we would have a more meaningful correction. But as it turns out, there's a possibility it may come in as a low, whether it's tomorrow or Monday, something like that. And if that happens and that does turn out to be a turn, then I think that could stage or build a foundation and set the stage for another leg higher, because I still do believe in the upside targets that you're seeing on the chart. I don't think we're done with the upside yet. And if you look at this, there's a couple of things going here. So all in all, this is a bullish pattern, right? Where there's nothing wrong with this chart. It's above moving averages. We're consolidating in the upper range of the chart. It's a bullish pattern. Even if you look at a weekly chart, here's a clean chart without the lines. But you can see here, we don't need this line on this chart, but you can see here that this is just in an uptrend. A weekly chart, it's in an uptrend. There's no signal of a top. All we're doing is backing and filling a little bit this week. So there's really nothing wrong with this chart, and there's no reason to believe at this point in time that we're still not going to power forward and make new highs. So back on our other chart, if we should come down tomorrow on the phony jobs number, let's say that's possible. So I've flagged the 226.27 level as an area that we could find some support on an intraday basis if we were to sell early in the morning on the phony jobs number and it had some follow through earlier in the day. And then generally, unless we're having a really terrible, throw up day to the downside, generally on Friday, the market will find a low early in the morning and then kind of float the rest of the day as the volume dries up. And that's generally the way Fridays go. with exception of, a just terrible day where the flood doors open up to the downside. Anything's possible. I don't see that happening, but 226.27 should find level of intraday support and on a phony jobs number. So that's an important number just to keep on the radar screen for those of you intraday traders. And by the way, on the flip side, if we spiked up on the phony jobs number, we would find some immediate resistance up at this gap fill up here. Comes in at about 229.50. So those are your kind of bookends. We're really in the middle there. So either way it's going to go, your upside resistance point, at least initially, would be the 229 to 229.50 area. And on the downside, you should find some support at 226, 226.27 is the number I came up with, down in that zone. So we sit pretty much in the middle there, so it could go either way. Going over to the IWM, a little bit of a down day today. We were pinched with the 20 and the 50 period moving average, and were shedded a little bit to the downside of that. Can't read too much into it. The IWM was down 50 cents or 1/3%, while the spider was basically flat. So I'm not going to read too much into that. We're still in a bullish pattern. And these moving averages, and the reason why I don't read too much into it just yet in terms of the moving averages, is when the market trades back and forth through moving averages, for example, whether it's on any time frame, whether it's a 10-minute or a 60 or a daily, like in this case, back and forth, it diminishes the importance of those moving averages. So a close below, a close above, I'm not really paying too much attention. What I am paying attention to is if we should significantly move, more so in one direction or another, because we are potentially, and for example on the downside, if we have a crossover of the 20 and the 50 period moving average, meaning the red, which is the 20, crosses over to the downside of the 50 as the market's coming down, right? The market's going to have to come down for that to happen. That's a bearish sign. That's a negative sign. That generally means that the market is changing character and there's more downside coming. But it's a moving average, therefore it moves with the market each and every day. We could get a spike higher and turn up the moving average, over the next couple of days. So we don't want to read too much into it. I'm just telling you how you can look at it. It's not something you can trade off of a daily moving average each and every day, but you can get them to give you a good indication of a trend, and that's what they are there for. Here's where we get into an anomaly for the day, and this is half the anomaly. So looking at the transports, and we saw a pretty negative day on the transports. In fact, they were down a lot more than they finished today. You can see here, they were all the way down at 90.47. So 50 points lower than where we finished the day. And it's interesting because when we have the transports having a really, really poor day, and we also have another index having a really, really poor day, which is the broker-dealer index, which is the financials, and they were down a lot more earlier in the day. You can see them came in to test or come up just short of the 20-period moving average. When those two indices are down simultaneously, or up for that matter, it's generally a pretty good indicator of where the broader market is headed that day. And today we had a divergence. So I'm not hanging my hat on that by any means. It could be a one-day wonder. However, that is in the forefront of my mind. It's a piece to the puzzle on the table, and it's a big piece to the puzzle because, like I said, when the market is trading in and around a certain area, and if you just flip back over to the spider, and we're trading in and around that 227.50 area for quite a while now, several days. And when that happens, it's generally coiling up for a larger move than what we've seen over the last 4 trading days. That's generally what this is telling us. Now, all in all, this is a bullish pattern, but on a micro scale, on a daily chart scale, meaning over the last several days, we have been building a bearish pattern. And if you look at it like this, we take this down move, and we're building a bearish pattern riding the 20-period moving average or the 227.50 area. if the market should choose to play this bear pattern out to the downside, we could come down to the 50-period moving average or someplace in between the 226 and the 50 area. That could certainly take place, and it could take place, in one shot. It could take place over a couple of days, maybe tomorrow and Monday, and we could find a low. And if we found a low, that could be the foundation for another move higher. That is possible. That would coincide with my cycle that I believe is culminating in and around this weekend. And so, these are the things that I'm looking at. I know I'm bouncing back and forth between markets, but they're all interrelated, not necessarily always, but the way I'm looking at it right now, I'm trying to get a read on any canary in the coal mines. Are the transports and the broker-dealers telling me that this bearish pattern may play out to the downside? And if it does, do we culminate on the downside into my cycle turn date, which sometimes you don't know which way a cycle is going to turn. You don't know until you get there whether we're trading into a low or into a high. Then we'll generally look for a turn. So the cycle date is coming, or the zone is coming. So when you think about it like that, if we trade down over the next couple of days, I would think I would be looking for signs of a bottom. And that's why I bounced back and forth and pointed out the anomalies in the transports and the broker-dealers, meaning the financials. And the reason I do that is because with the financials, the market really can't stage a rally of any substance without participation from the financials. Can it rally without the transports? It could. But it generally doesn't rally without the financials. So when you have the transports and the financials down, less likely to see a rally. So be curious to see what happens tomorrow. And I think the phony jobs number will be a good catalyst for the market to pick a direction out of this coiled up position in and around 227.50. So look for a move tomorrow. Either up to the 229 and change area or down to the 226 and change area. That's my take on the next move in the market. I think it's sooner than later. When you look over at the gold market, here's another clue, possibly. Now, gold's higher, and what's the reason it's higher? Well, it's higher because it's higher, right? But, if you ask the media, there has to be a reason. Therefore, maybe it's the fear trade. They wouldn't have anything today to hang their hat on. They'll make up a story. But if the market's going to go down, they could pin it on the fear trade. So is this a foretelling of something to come, meaning the market being down over the next day or two? I have been saying, and I tried to say it last night when the video didn't have the audio, but I didn't think that the gold market would have the oomph to get through the old highs at 1225, and not knowing, obviously, today we would get up there, but we didn't have enough to get through there. So maybe we do, maybe we don't. It's just not something I believe it has. I would like to see the market consolidate for a longer period of time. And what I tried to show last night, and what I'll show tonight, was you can see here we're into the weekly 20-period moving average. And sure, we can bust through it, but generally, you would need more time to consolidate, to build enough energy to get that next leg higher that would bring us up to that 1270 area. And that's really where the market would want to go on the next push higher. If we started higher now, I don't believe we have enough to get there, and we would most likely fail again at some point, not too far away from where we are, 12 and a quarter, 1230, something like that. So I don't see much higher prices, but of course, if I'm wrong, I'm wrong. I'm just not willing to establish a long position here. I guess that's what I'm trying to say. The odds are not in your favor of having a continuation move in gold higher. It's not to say it can't happen. It's just where the probabilities are. The probabilities are that it just needs more time to consolidate for another push higher. The other thing that I tried to show last night that's worth showing is, it's off the chart now, but there was a fake print on the GDX up to 25. And generally what that means is it's not a trade that actually happened, but somehow it went into the system for everyone to see. And when that happens, it's not something you trade off of, but it could be a tip of the hand to a near-term price that's likely to get hit. And since it came to 25, which also happens to be a nice juicy round number, which also happens to be the 200-day moving average, it makes a lot of sense, and we're starting to see gold edge up a little bit, so I wouldn't be surprised to see 25 hit sooner than later. That would provide a high level of resistance in my book. However, I wouldn't be surprised to see 25 in the GDX hit over the next day or so, and that's off that fake print that was on the chart last night. Even if you go back to watch the video last night without the audio, you'll see the fake print on the GDX chart that I pointed out. Heading over to silver. The silver could be putting in a sideways bullish consolidation pattern, and that would certainly be building energy for another move higher, and that move higher would likely get us up into the $18 area, the 200 period moving average. That's the trend right now. Your moving averages, your 20 moving average is upsloping. So as the days go on and as the moving average slopes up, it has the propensity, silver does, to continue to move higher. So this is in an uptrend, and there's nothing wrong with silver, and it's inside this green candle here. So as long as we stay above 1710 on a daily chart closing basis, this is a bullish pattern, no two ways about it. But it would generally need more time. Another 2 or 3 days would be nice to see before making another push higher. That would kind of solidify, and it would increase the odds that another move higher is coming if we were to see another 2 or 3 days of sideways movement in silver. Moving over to crude oil. Again, last night I tried to tell you that crude looked like it wanted to go higher. Obviously, you couldn't hear me. However, crude went higher and pulled back and closed below the important level of 53.79. So I think that's that level is important. We've got to close above that level for 2 days in a row. We closed above it last night, and then was not able to. We'll see where the 6 o'clock close is. Pardon me, So we'll see where the daily close is, and we may yet close above there. But it looks like it wants to go higher, and as long as we stay above these moving averages, crude oil looks like it wants to move and make its way higher. And the next real level is going to be $54.50 to $55. And what I was pointing out last night is the 54.60 level is important. This is the top end of the red candle high from the 9th of January. That's an important level. Right above there, you have a lot of pivot highs, and they're at all different prices. So I say between this pivot high of 54.60 and 55 is really the next level that crude wants to get to. Now that means wants to get to. Getting through there will be another challenge. Once it begins to get through that level, then I think that crude is going to want to make its way all the way up to, and not in one shot, but all the way up to, on a longer term basis, up near the $59.60 level. The reason I say that is when you look at the weekly chart, this is a very bullish pattern. On the weekly chart, we had an up move, and now we're going sideways and have been for 10 weeks. So I think we're culminating into an important time frame. So I wouldn't be surprised to see an upward movement begin around now in crude oil. If it's going to make a move, now is as good a time as any for this to begin. And so you can see the important levels on the chart. So mathematically, we're going to have to get above these levels. I've got 54.60. We just talked about 56.15. Once we clear that, then I believe 59 to 60 is coming. And out of this bullish pattern, that's what you would likely see. That's what you would traditionally see. The problem is this bullish pattern is intact all the way down to 46.67 on a weekly chart closing basis. So it's a very difficult trade. It's a very difficult trade to trade in crude futures, for one. However, those of you that would like to take a trade in the energy sector and can play something that's a little less volatile than playing the actual crude futures contract, it's not the worst bet in the world. And I think I'll be putting out a trade or two in the energy sector, hopefully tomorrow. So we'll leave it at that. Just like to see a little more confirmation in crude oil before making that final. So we'll see how it shapes up over the next day or so. If it gets pulled down with the market, if we see the downside tomorrow, we'll see, where it holds up, if it holds up, and then, we'll kind of see one day at a time what happens. Next up is the 30-year Treasury bond. Could see what happened. We tried to make a run for the 20-period moving average and was rejected, and therefore this bearish pattern that stays inside of this red candle here, at 151.2, as long as we remain on a daily closing basis below that level, this is a bearish pattern likely to retest 149. With the phony jobs number tomorrow, is tomorrow the perfect excuse for that to happen in the morning? We'll see. Could be. This is what's setting up. And today was day 7 out of this bearish pattern, day 6 from the low. So we'll see. Tomorrow's an important day. And last but not least, we'll take a peek at the dollar. So a little bit of an uptick in the dollar. So the 99.60 level is holding. However, we are now making a bearish pattern. So if we're going to move lower, let's have another price in mind. If we break today's low on a closing basis, for example, then the more likely scenario would be that we were going to come down to the 200-period moving average and pierce through, call it 97, and that would be an area that would likely provide a pretty good bounce higher in the dollar. And so unless we can sustain, kind of build a base and move higher out of this area here at the 99.60 level, if this isn't going to hold, then we come down to the 200-period moving average. That's the bottom line. So with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.